All right, if you're a high-volume crypto trader, you need to pay close attention. The IRS is dropping a whole new set of rules, and trust me, the consequences for not having your records buttoned up are, well, they're more severe than ever before. This isn't just a small tweak. We are talking about a fundamental, ground-up shift in how you have to track and report every single one of your transactions. So yeah, let's get right into it.
I want you to really let this sink in. This quote, it just cuts right to the heart of the matter. And it's not hyperbole, not at all. Think about it. If you can't prove what you paid for your crypto, the IRS has the green light to treat every single penny of the sale price as pure taxable profit. The stakes? Yeah, they really couldn't be any higher. Okay, so here's the game plan for today. We're going to break down exactly what you need to know. First up, the substantiation mandate. That's the legal groundwork. Then we'll get into this huge shift to wallet-by-wallet tracking. After that, we'll dig into the nitty-gritty of Form 8949, especially for you high-volume folks. And we'll wrap up with the absolutely critical transition you have to make before January 1st, 2025. Let's go. All right, let's start at the beginning. We need to talk about the one core principle that underpins, well, everything we're discussing. It's called the Doctrine of Substantiation. And just to be clear, this has nothing to do with crypto specifically. This is the legal foundation of your entire tax liability, period. Now, the two most important words on this slide are affirmative duty. And let me tell you, that is not a suggestion, it's a command. See, the entire U.S. tax system is built on this one idea. You, the taxpayer, are on the hook for keeping all the records needed to prove your own numbers. The burden of proof, it's 100% on you.
And this isn't just a good idea, it's the law. It's written right into the Internal Revenue Code, Section 6001. That's the legal muscle behind all of this. It basically gives the Treasury the power to say, hey, you have to keep these records. What that really does is shift the entire burden of data storage from the government straight to you. And in the world of crypto, that's a huge deal. You know, exchanges go bust, APIs get shut down, your records can just vanish. That's a massive, massive legal risk. Okay, and this is where things get really, really serious. Let's say you get audited. The IRS sends you something called a notice of deficiency. Well, the law automatically presumes the IRS is correct. That's right, the burden is on you to prove them wrong. It's the complete opposite of innocent until proven guilty. In tax court, you walk in and the IRS is already considered right. Your only hope is to have the records to prove your case. So what's the logical conclusion here? What happens if you can't come up with those records? Simple. The IRS assigns you a cost basis of zero. Zilch. Nada. And you've got to understand, this isn't the IRS slapping you with a penalty. It's just math. The formula is simple. Gain equals proceeds minus basis. If your basis can't be proven, it defaults to zero. And what does that mean? It means your taxable gain is suddenly 100% of whatever you sold it for. And this right here, this is the nightmare scenario. It's what keeps crypto CPAs up at night. Just imagine for a second. You're a high-frequency trader. You're doing a ton of volume, say $50 million. But at the end of the day, your actual profit is only, $50K. But you don't have the records. So guess what? The IRS can come in and decide to tax you on the full $50 million. I'm not kidding. And please don't think this is just some scare tactic. It's not a hypothetical. There's real legal precedent here. Look up the case Carrera v. Commissioner. The court sided with the IRS on a zero-basis determination because the taxpayer just couldn't produce the records. Okay, so we've established the why, the legal doctrine, but how does this actually apply in the real world? What does it mean for you day to day? Well, that brings us to our next big topic, because the rules for how you prove your basis are undergoing a massive change. We are now entering the new wallet-by-wallet reality. So for the longest time, the unofficial way of doing things was this universal method. You could basically lump all your crypto together from every wallet, every exchange, into one big pool. And from there, you could use strategies like HIFO, highest in, first out, to try and minimize your tax bill. It was a de facto accepted practice. Well, that's over. Done. The new Treasury Regulation, and you're going to want to remember this one, Section 1.1012-1J, makes it crystal clear. You must track your basis separately for every single account, every wallet, no more pooling. And the clock is ticking. This new mandate kicks in on January 1st, 2025. Okay, so new rules, new reality. How in the world are you supposed to actually report all of this? That question brings us to the really practical side of things, the mechanics of compliance, and it all revolves around one particular form, IRS Form 8949. Look, If you're a serious trader, you might have tens of thousands, maybe hundreds of thousands of trades in a year. The idea of listing every single one of those on a separate line of a tax form it's just insane. It's impossible. The good news is, the IRS gets it. They're not completely oblivious. So they've provided a procedural out, a workaround, called Exception 2. This allows for summary reporting, and for any high-frequency trader, this isn't just helpful, it's absolutely essential. So here's the playbook for using it. Step 1, you report your aggregate totals, your total proceeds, total cost basis, on just one single line of the form. Step 2, in column F of that form, you put the code M. That little letter is your signal to the IRS that says, hey, the details are coming, they're in an attachment. And this next part is the most important part of all. You must attach a detailed statement that lists out every single transaction. It has to be a PDF if you e-file, or you got to mail it in with a Form 8453. And you have to do it when you file.
Okay, I need everyone to listen to this because it's probably one of the most dangerous myths floating around in the crypto tax world. You cannot, I repeat, cannot, just write details available upon request on your Form 8949. It might seem easy, but it's a huge mistake. Our source material calls this a pervasive and dangerous misconception for a reason. If you do this, the IRS considers your return substantially incomplete. And you know what that means? The statute of limitations might never even start ticking. They could come back and audit that year 5, 10, 20 years from now. It's an open wound forever. The data has to be there when you file, period.
And just when you thought it couldn't get more complicated, starting in tax year 2025, we've got the new Form 1099-DA. Now, your broker is going to report your gross proceeds directly to the IRS. So just look at this table. It tells the whole story. Let's say you report your net profit of 100 grand, but the IRS gets a 1099-DA from your broker saying you had 10 million in gross proceeds. What do you think their computer system is going to do? It's going to see a $9.9 million discrepancy, and its little robot brain is going to immediately flag that as unreported income. That's an automatic audit letter in your mailbox. This is why your Form 8949 has to show the full gross proceeds and then subtract your fully proven substantiated basis. Whew. Okay, so that's a lot to take in. The big question is, what do you do right now? And that's what we're going to cover in our final section. The critical must-do actions to get ready for this new reality, and the one-time-only chance the IRS is giving everyone to get their house in order. This timeline really lays it all out. It shows you just how fast things are changing. Think about it. Before 2024, it was the Wild West. The universal method was fine. Now, for 2024, wallet by wallet is the law. Next year, 2025, bam, brokers start reporting your gross proceeds on the 1099-DA. And by 2026, they'll be reporting your basis too. You see the trend here? The compliance screws are tightening, and they're tightening fast. That's why this transition period is just so incredibly important. Now, the IRS isn't totally heartless. They seem to understand that this is a huge, huge shift for everybody. So they issued something called Revenue Procedure 2024-28. Honestly, you should think of this document as your lifeline. It's a transitional safe harbor, basically a one-time get-out-of-jail-free card to get all your records straightened out and aligned with this new wallet-by-wallet world. So what does this safe harbor actually let you do? Well, here it is. For one last time, it lets you take your total unused basis from everywhere, all your assets, and assign it to the specific assets you hold in each of your wallets. But, and this is a huge but, there are some serious conditions. First, you have to do this as of January 1st, 2025. Second, and this is the big one, the allocation is irrevocable. Once you do it, you can't undo it. It's locked in forever. And to do this, you absolutely must create and save a detailed, documented snapshot of your entire portfolio and how you allocated that basis. And I mean save it like your life depends on it. Because if you lose that snapshot, you could lose the ability to prove the basis of your older assets for good. So what's the bottom line here? What does all this mean? It boils down to a fundamental shift in how you think about your records. You are no longer just doing bookkeeping for tax prep. That's over. You now need to be building a forensic-level database, something that's ready for tax litigation. Your new motto, your guiding principle, has to be this. Assume an audit is not a maybe. Assume it's an is. It's inevitable. So, I'm going to leave you with one final question to chew on. Maybe you were an early adopter. You bought some Bitcoin way back in 2013. You know in your heart that it has a cost basis. But when January 1st, 2025 rolls around and you're living under this brand new, much stricter IRS regime, the only question that the IRS is going to ask, and the only one that truly matters, is, can you prove it?